After a bullish week last week, markets around the world took a breather as the stock rally stalled. So what happens next? Today, we discuss that and future returns. Markets are priced to perfection with valuations at all-time highs, and we need to talk about what that means for future returns. We're also going to be talking about fund managers, what they're doing and what they're buying. Got a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers. It was a very muted day today. There wasn't much going on in the market, not much news, fairly light volume overall. It is a shortened trading week nonetheless, but yeah, pretty red across the board. Nvidia eked out again, same with Amazon and Tesla. That did help the market a little bit, but look at these bigger boys right here. Pretty red all in all. Energy on what oil prices did tick up quite significantly. We saw a little bit of buying here in drug manufacturers, but they got hammered last week. So, fair is fair when you look at it in that regard. All in all, I wouldn't even say we're getting defensive per se, because look at staples, look at utilities, slight bit up. You can call it flat, I guess. Shut index was pretty green, but this looked like a liquidation. This kind of just looked like a breather from last week's rally. Now looking at sectors, now look at the start of the session. Look at who were the winners, right? You had GDX, metals and minings, and then what finished the session higher, XLE. So these are like, energy, gold, utilities, metals, mining, right? A lot of these sectors are heavily influenced by geopolitics, maybe not so much utilities, but that's why these sectors right here were, had a lot of volatility to the upside and then the downside at the start of the day. The losers today were home builders. I think I saw some real estate data come in pretty flat. Technology as well down, same with industrials, real estate, financials, software, XLC, discretionary. And I mean, these were really the winners last week. I know it's a broad range of stocks that got there, but they were all up like 1.5, 1.6, 1.7% for the week. And for a sector, that's really good, because whatever the sector performs, you kind of like multiply by 2, and that's sort of what like stocks did in that sector. Most stocks were up like 3 to 4% after last week's FOMC. But let's actually hop on the chart, see what today looked like. Now, looking at the major indices, look at the Nasdaq, S&P 500 down both 0.3%. The RSP slightly beat. Mid-caps were flat on the day. The S&P 600 down 0.28%. Look, there's not much to add, guys, here with the market today. Very muted action across the board, but the IWM did gain ever so slightly. And then we saw Bitcoin was up 5% above the 70,000 handle. And then when you actually look at it right now, you look at this chart and you can see, yeah, okay, we got a higher low forming, going for all-time highs. And in hindsight, for those trading Bitcoin, you look at this low and say, okay, that would have actually been a good opportunity, because it was a 17% drawdown peak to trough. That being said, when you're actually in the trade and you're down like 17%, it's a lot harder to actually put that trade on than it looks. But gold slightly gained, the dollar slightly lost, crude was up 1.64% on some geopolitics. But let's actually have a look at the S&P 500. This is the daily chart. Now guys, there's actually not much to add here with what stocks did today. A very muted day of trade, but the two key levels we're looking at for the rest of the week were these two levels right here. We're not at those levels, and there is a bit of data at the end of this week that's really going to cause some volatility, I guess, like PCE. Inflation is sort of like a non-event now, but yeah, until we actually get to maybe these key levels and see how we react, the market is not really going to do much of anything. We could rally, we could sell. I mean, a very muted day of trade today, and considering there's only 4 days left in this week, you thought there'd be more volume in today's trade, but there just wasn't on a relative basis. So the market is sort of just doing what the market normally does, and that's just having a trading day before Good Friday. A lot of people might be taking some time off, and that's why we're kind of seeing this muted trade. But looking at the 5-minute chart, guys, a 20-point range after a gap down, and we had this very muted range right here. Sellers came in at the top, but definitely a win to the bears. But on a 20-point trading range, on a day like this when it's red, the bears really want to try and push as much of this market lower, and they simply couldn't do that. All in all, not much to add, guys, not much at all to add. All the charts kind of look very much the same. We're sort of like waiting for a pullback to key levels here on the RSP. A very similar situation to mid caps. You probably want to look at something like that right there. Looking at the S&P 600, again, if we are going to pull back, it's going to be to one of these levels right here. Anything below it, and it can be a bit grim, and then the IWM as well. So yeah, guys, not much to add on the charts today. There wasn't much going on. There wasn't much fundamental news, macro news. Not a big week of earnings. A lot of the data is back end loaded. So just a light day of trade in the market. Far and few between between, but we tend to get these types of days around public holidays. Now, the weekend poll just wrapped up. Thank you each and every single one of you who voted. Now, the question is, the next 100 points in the S&P 500, where do you think it's going to go, up or down? 51% of you said up, 49% of you said down, a slight edge to the bulls. Now, leave in the comment section below if I should add like a third column, like flat or neutral. There's not much to go off with this week's poll. Very split 50-50, and I'd love to see where this finishes up at the end of the week. Now, what is this week likely going to look like? Well, according to the stats right here, this is the S&P 500 performance in the last week of March, based on the performance from March 14th to the 24th. So 10 days, we'll call it the 10 days. And you can see that when the last 10 days is positive, greater than 1.2%, which we are right now, we actually are up 1.67% in the same 10-day period. Normally, we actually get a very red negative week, down 0.74%, 3 wins, 10 losses. And even when we do get these 3 wins, they tend to be very light. We'd have a pretty big win here in 2023. However, brutal finishes when this period right here is positive. And if we do see a bit of downside this week, it's completely normal. It's actually well within the stats, and it shouldn't scare you, because at the end of the day, guys, stocks go up, stocks go down. This is the S&P 500 returns, max pullback and average pullback. Now, on average, the S&P 500 pulls back about 14.2% when we do get a peak to trough drawdown. Now, you can see that varies in year. For the most part, the S&P 500 normally finishes positive on the year. Now, let's look at a similar year like 2024. Let's just take 1996, right? So we could see a 1996 returned 22%. We actually had a pullback in that year of negative 7.6%. So there was actually a time in the year where your return could have been 27.6% had you bought the low of the year. So we can actually have substantial pullbacks and have very positive years. Look at 1997, the year I was born. 10.8% pullback, a double-digit pullback, correction territory. What was the return that year? 30%. Now, I do understand 95, 96, 97, 98, crazy time periods, but you have to admit 2024 does feel a lot like this time period right here. And at the end of the day, guys, no one really knows what's going to happen. I don't know what's going to happen in the market tomorrow or next month. However, what I can do is play the probabilities and adjust for risk. And I could say, hey, January, February, March have all been higher. What does this usually mean for the rest of the year? On average, we normally see 9.8% return, median return 9.8%, 19 wins out of 20 times this has happened, 95% hit rate. And you could say from that, okay, well, any pullbacks I do get in the market, they do come this week. You just look at those pullbacks as opportunities to get in for what can be a pretty stellar year. And I do think fund managers are looking at stats and data points like this because fund managers are heavily invested in equities. This is the NAM number, the latest NAM exposure index number, and it essentially tells us how exposed US fund managers are to US equities. And right now in their portfolios, they're 93.2% exposed to equities. And generally speaking, we get to these levels right here in very bullish bull markets. Now, we only have the stats for 24, 23, and 2022, but you can see that from the lows, this actually trended up. So when we were rallying, when we were entering this massive cycle we're in right now, the AI cycle, the bull market cycle, you know, the mid 2020 cycle, whatever you want to call it, okay? What has happened in that time period? US equity exposure has increased, and you can see we're sort of peaking out. We were at 104% last week. We're at 93.2% this week. And this isn't a reason to sell. This is simply a reason to stay bullish and hold your equities. And this is what FMS investors were buying, fund managers were buying. They were buying the Eurozone, EM, emerging markets, banks. Okay, what do all three of those have in common? They're value names, value stocks, and they trade at pretty good valuations. Look at what they were selling: tech, discretionary, US. Now, I really do want to talk about the Eurozone a little more because it's very interesting. And this is ultimately the reason why fund managers are looking for value right now. So just with the next data point I'm going to show you, remember that the S&P 500 trades at 21 times. Europe trades at 13.4, we'll call it 13 to 14 times, right? Now, this is smooth PE ratios and future returns, and essentially 10-year future excess stock returns. And it's just essentially what return we can expect every single year for the next 10 years. Now, at a 13 PE, at a 14 PE right here, okay, in this box, look at the 10-year annualized returns we can expect. It's almost all positive. There's no negative returns, Just for the record, this right here is 0. 0.05 means 5%, 10%, 15%, 20%. This is the entire returns for stocks at a 13 PE. Almost no negative returns, a slight outlier right here, almost always positive. And we see a huge concentration of gains right here at 5%, and then a huge concentration above 10% as well. And that's why fund managers are looking at places like Europe, like emerging markets. In comparison to the US right here with a 21 PE, what do we find? We actually see, yes, we do get positive gains. We can have 10-year positive annualized returns. However, the majority of it is focused below 5%. So you'll get between 0 and 5% returns. And we also have a ton of returns that are negative compared to a 13 PE where we virtually have 0. And that's why fund managers are looking at Europe, looking at emerging markets, trying to find attractively priced stocks, because in the long run, that is going to do better versus stocks with higher PE ratios, which have pretty much pulled all of their future returns forward. Now, looking at Gamma, exactly what I said would happen happened. We were at 5250 on Friday. I said we're going to get to 5300 very, very quickly. The market hates the 50 levels. They always just want to go to the next one higher. The call gamma strike has moved to 5300. And that pretty much means we're going to buy dips, sell rips in a positive gamma environment into the 5300 strike. And this is actually really, really positive for April as we leave the window of weakness and look towards OPEX. So we're definitely probably going to go touch that 5300 strike before the April OPEX 100% if we don't move higher in that time already. So do expect 5300 to hit, especially with the fact that there's not a lot of negative gamma on the tape with respect to positive gamma. So buy dips, sell rips until we get into a negative gamma environment, and that would be when we move below the gamma flip zone and we see more negative gamma on the tape visually than positive gamma. So it's that time of the week again, guys, where we look at institutional charts, BOFA charts. 78% of fund managers have access to BOFA data. BOFA give their technical analysis by their technicians every single week. So the big boys are looking at this, and that's why we look at it every single week and go over it quite extensively. And it's a really good look into what the big guys are looking at. And sometimes just basic technical analysis we overlook for very complicated strategies. And then you just look at the chart and you can see, okay, this is in an uptrend, cup and handle, measured move upside targets 5200, 5600, 6150 on the upper end, and support levels here 4800, 4700, 4630, 45.95. We pull back, we can look to higher price action, and very, very simple charts right here that BOFA technicians have outlined. And sometimes the best trade is just the easiest. So there's the S&P 500 levels. Now looking at breadth metrics, the New York Stock Exchange Composite, this is the cumulative up volume for the NYSE, and then the NYSE itself, the composite index. Now the New York Stock Exchange cumulative net up volume broke out from a year-long head and shoulders bottom. This is a bullish sign for market volume, suggesting a bullish trend of accumulation versus distribution on the NYSE. In other words, right here, volume is going up. Fund managers are buying instead of selling, and this is why indices are rallying. And when indices are moving higher, you want to see cumulative net up volume. That's what we're seeing. The one chart confirms the other. Now looking at the Russell 2000, now we are in the context of an uptrend. You could see here we put in a low, then we put in a high, then we actually put in equal higher lows, kind of, although it's been, 18 months. And we are attempting a breakout to go ahead and break this high. Now what BOFA says, if we decisively break above the 208 to 212 level, and that's the language they use, a decisive breakout. We break above here, okay, we can look to upside targets, 234, 244, 250 to 255. So we break above, and then we can use these levels as support, right, to go ahead and hit the upside targets and possibly new all-time highs in the Russell 2000. But it's all dependent if we can break above the 208 to 212 level. Looking at the Russell 1000 value, they hit new all-time highs after breaking out of this triangle we formed right here. We broke out. A measured move would take us from the lows to the breakout level of 195, 208, and that would represent something like a 30 to 40% upside rally if we do get to those levels. And we could pull back to support levels of 171, 169, and then rally all the way to possibly a 200 handle and above. Looking at the Russell 1000 growth, very similar to the S&P 500, we formed a cup and handle right here. We've broken above the top of the handle. A measured move takes us to 370, 340, 340, 420, anywhere from 30 to 40% above the current price, with support levels at 312, 1287, 285, but anything below here could spell trouble. But we could pull back, use a support, look to 340, look to 370, look to 420 on the Russell 1000 Growth Index. And again, all of this stuff is not in 1 month, not in 2 months, probably 12 months minimum. Now looking at the Russell 1000 value relative to the S&P 500, and it seems that large cap stocks have just outperformed value stocks as a whole. The IWD remains within a lagging trend versus the S&P 500, with a major bearish breakdown for value in late 2023. So it still pays to hold, I guess you could say, large cap growth. Looking at the Russell 1000 growth against the S&P 500, although IWF has stalled at its old highs versus SPX, the leadership trend for growth remains intact. In other words, we're kind of seeing a broadening out right here, the S&P 500 performing a little bit better than the Russell 1000 growth, but we are in the uptrend, and that means you still want to favor growth assets over value assets and growth assets over anything else. Now looking at the Nikkei 225, we formed a massive 3-decade big base right here, and we've started to break out from this base. The breakout has started at the December 1989 peak, as you can see right there. We've broken above, and a measured move takes us to 41,500 in the Nikkei, 44,000 to the upside, as long as the 38,200 level holds. So if we pull back to here, use our support, find bullish demand, we can then look to 41,500, 44,000, and then we could readjust our upside targets from there. But these are the targets we want to look at, particularly that 44,000 level. Now looking at some bull market overlays and a bull market roadmap, in April, the S&P 500 will enter the 11th year of its secular bull market, signaled on the breakout to new highs in 2023. The current secular bull market from the 2013 breakout above the prior highs from 2007 is middle age and can last until the late 2020s, early 2030s. So you can see here's the breakout that happened in 2013. So we had the GFC crash right here. At those highs, we break above it. That's the start of a new bull market. It's been about 11, maybe 11 and a half years since. And generally speaking, the average bull market lasts for about 24 to 26 years. And that means it could take us to about 2031, 2032 to the upside, and maybe an 8,000, 10,000 S&P 500 in the next 8 to 10 years. Looking at some more overlays. Okay, this is a very interesting chart from BOFA. So it's S&P 500 overlays, right? So the rallies from 2009, 1974, 1942 generational lows. These are monthly charts. Now the S&P 500 rally from March 09 low has exceeded the rallies from 1974 and 1942 at the same lows. The S&P 500 surpassed 5,000 in February, but the upcycles from the 1974 and 42 general lows projected off the 2009 lows do not reach the S&P 5000 until 2027 and mid 2025. So we're traveling ahead of schedule, guys. The S&P 500 also hit 3,000, 4,000, well ahead of schedule based on the general lows overlay. So you can see here that we're trending above these 2 years, 1974, 1942, and we've been very, very strong off the 2008 lows. This was an absolute generational buying opportunity. Had you got in, we've never seen these lows ever again, even after the Rona crash, and we are trading ahead of schedule. Now, normally we would actually see 5,000 S&P 500 according to these overlays here in 2025, late 2027. But if we look to absolute upside targets, if we are to follow the 1974 chart, this green one right here, it would take us to an absolute maximum move very close to 18,000 and the end of the rally to 13,005. And then from 1942 would actually take us to about a 10,000 S&P. It seems crazy that the S&P 500 can actually go ahead and like double from here, maybe even triple in some instances. However, these are the markets, these are the overlays, and relative to history, this is what previous bull markets looked like. Kind of crazy when you put it in this perspective. Now, these are secular bull market breakouts. So when we actually retook the high after we had a massive drawdown, so bull market breakouts, what are the returns and what do the overlay charts look like? Now, the overlay charts that line up with secular bull market breakouts from 1950, 1980, 2013 suggest that the S&P 500 can spend much of 2024 north of 5,000. As you can see right here, these overlay charts are kind of in line. We're a bit ahead of the 1950 chart right here, as well as in line with the 1980 chart. And you can see that it means we could spend much of 2024 above the 5,000 level, and we could reach upside targets in the S&P 500 right now, according to these overlays of 6,500, and on the very, very high end, 7,200 in the S&P 500. And we would achieve these sort of by the end of 2027. So we're looking at about 3 years in the future. And you think about that, 3 years, 50% gain, not bad, not a bad store of value. Looking at some more overlay charts, incredible. Very similar to the very first overlay chart. So it's secular overlay charts from the start of secular bear markets from 1937, 1966, and 2000, and what they can return. So pretty much, from the highs to the start of the bear market, what can we expect? According to these charts right here, it suggests that the S&P 500 can spend much of 2024 above 5,000. We're kind of tracking in line with previous markets when we look at it in this instance, and we could see that upper end targets can take us to a 6,000 S&P 500, and on the upper end, 8,763, 19,500, and possibly as high as about 27,000 in the S&P 500. And according to these charts here from BOFA, we could probably see, these ranges that I've just shown you, 8,000, 19,500, 27,000 in the S&P 500. We can achieve those in like 2039, 2035, around that period. So we're looking at like 10 years, 11 years, 12 years from where we are right now. That being said, based on all of these overlay charts I've shown you guys, the S&P 500, according to other bull markets, has a long way to go before we really see a maximum drawdown. That being said, anything can happen, but we're just drawing on history to see what might happen. Data in the week ahead, the focus will be on personal income outlays and GDP, as well as housing data. The big one's going to be PCE month over month, year over year, both headline and core. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.